Thank you, Senator Scott. We're here today, as we do every 6 months at least, from Chair of the Federal Reserve, Jerome Powell, on monetary policy, the state of our economy. Please proceed. Thank you for your service to our country.
Thank you, Chairman.
For those who are tuning in, we have Jerome Powell giving his testimony in front of the Senate Financial Services Committee. Just as a reminder, he gave this same exact talk yesterday in front of the House Financial Services Committee. Both of them, complete waste of time. Both of them, a waste of our money and a waste of our tax dollars. But it's a chance for the markets to fake a lot of traders out, convince everyone to get on the wrong side of the trades, and then use that liquidity. So we put ourselves in the mindset of institutional traders. We're gonna scoop up a pretty good discount price today to buy the stock market. Everyone's gonna panic into selling because they think Jerome. Look at the last 50 appearances from Jerome Powell and let me know when the last time the markets were bearish when he was speaking. Right? Go do this experiment after this. Right? So if you guys are wondering why I'm still bullish, even though regardless of what he says, that's why. Plus, the same canned speech that he gave yesterday is exactly what he's giving today. And they're going to ask him for 4 hours about shit that has nothing to do with the Fed, like immigration policy and transgender bathrooms and shit that has nothing to do with the Federal Reserve. And he's going to have to sit there and remind them for 4 hours that it's their job to handle these things because they're the lawmakers. And he's an independent agency taking care of the dollar. That's it. And so that's what the next couple of hours are going to be like. I'm not going to stream the entire thing. I'm streaming just enough to figure out if this is the same speech he gave yesterday. If the answer is yes, I'll just give you guys the rundown of how that went. Cool? Deal? Yeah, I'm looking for buys on NASDAQ in case anyone's surprised.
Dude, over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined, and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices, or PCE prices, rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Longer-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We have also continued to shrink our balance sheet at a brisk pace and in a predictable manner. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% inflation objective is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress that we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Mr. Chairman. You've acknowledged the Fed likely waited too long to raise rates when prices shot up in 2021. We can't make that mistake again, Mr. Chair, at the expense of workers. If the Fed waits until unemployment starts increasing, it may be too late to cut rates in time to save American jobs. Why shouldn't the Fed act now to prevent workers from losing their jobs rather than reacting after the fact?
So we're well aware of that risk, of course, and
Solid question. You know what? I was giving Congress flack at first. That was a solid question about the timing. Jerome Powell wearing a purple tie. I don't know if you guys paid attention to this, but in the past, analysts would try to figure out any sentiment from the Fed based on body language, posture, eye contact, what they were wearing. Purple tie, ballsy choice from Jerome.
We hear privately also that the state of our economy hit the hardest with inflation. They're also hit the hardest when companies try to cut costs with layoffs. This town too often seems to forget that maximum employment is part of the Fed's dual mandate. Let me ask you about bank supervision. Senator Scott mentioned that. Last year's bank failures illustrate the need for strong oversight. SVB grew too big, too fast. Fed supervision didn't react decisively enough. The Fed, in response, undertook an assessment of its supervisory process to identify and address gaps related to the speed, the force, the agility, if that's the right word, of its supervision. Explain what concrete steps the Federal Reserve's taken to strengthen supervision and any specific areas where work to make improvements is ongoing.
so this is a very broad area of work. There are, many people in the Federal Reserve System who are involved in supervision, thousands of them. And there's a rule book. And so there's been careful study and thought and a lot of listening to understand how we can meet those goals of being quicker and more effective, basically, is how I would say it. If you look at Silicon Valley Bank, we weren't quick enough and we weren't effective enough where we were in. And so we're working hard to develop a new rule book and another set of practices, which is still going to be evidence-based and fair, but it's going to involve earlier interventions and more effective ones. And I think this is work that's ongoing and will be for some time.
Thank you. The job of the Fed, of all public officials, is to serve the American people, not their stock portfolios. We've seen abuses in this body. We've seen abuses at the Federal Reserve. I wrote to you last month asking the Fed to
I worked at Congress, I think, 7 years ago. All right, Senator Brown's voice has not changed the whole time. I don't know what's going on. Buddy can afford all the best doctors in the world. I don't know what's up with homie's voice. He does not give enough speeches for his voice to sound like that. All right, I stream longer than homie speaks in a day. I'm just throwing that out there.
And in the sixth one was what you said, and I just said we're going to do all of these. Let's get going. So we've done 5 of them, and we're working on the 6th.
and it will be finished within 6 months when you're back.
I want to get it right. I certainly hope so and expect so.
Expect so is a better answer than hope so.
For anybody wondering, I am not in this trade. So we had a very close pullback to our entry zone. I'm waiting for another pullback. If it doesn't happen during today's session, it'll be the exact same as yesterday, where the market kind of had this rejection during the first half. So this is right at the market open. Market pulled back as soon as Powell started speaking. And then there was an entry very close to the Australia session lows. But the real entry happened during London session. And so during yesterday's Australia session, we had the first pump, and then we had the retest during London. So for today, same thing. We had our rejection right at the market open. I think the market's going to end up consolidating or continuing to push towards this 88.6. And then in the second half of the session, I'm expecting a pullback to 18,100. we're damn near 90 or 80% of the way to the target. So buying it while it's close to the target, about the stupidest thing we can do, right? Because then we're just going to be buying into the retracement. So the only two options are, if you're going to be shorting and trading against the market, you'll wait until this 18,260. But if you're trading with the trend, which is personally what I'm doing, you'll wait for 18,100. Okay. And if you're just going to enter a random trade just because you're on the charts and you got to do something just to get your heart pumping, I don't know. Go start skydiving or something. Get out of your system somewhere else. Trading is not the place for it. All right, let's get back to the hearing.
Inflation we've seen over the last few years, if the supply chain, for instance, of autos had been more resilient, or if there had been more housing availability, would that have made your job easier?
Yes, in a word. Yeah, a big part of the inflation was, and we saw it in 2023 when the supply chain problems unwound and when the labor supply shock that we had unwound as well. We saw inflation come down very quickly in the second half of the year. But it's also down to tight monetary policies playing a role as well.
Which leads me to the plea with you to speak out about inflation, about the contribution of corporate profits and greed to inflation. Thank you.
Oh, I know you are done. That's true. Well, I was
Seeing yourself agreeing with me more and more often. Is that what?
that would be a nightmare and I'm awake. So
Yeah, they got
What's
jokes
that?
today.
The fact of the matter is that so often, if in fact 60%, I actually listened to what you said, which was remarkable. The fact that 60% of Americans today can't afford $1,000 emergency. I can't imagine how the average millennial affords a down payment for a home. I can't imagine how they take into consideration when they're looking at a snapshot of their financial future, fixing and repairing or having a plan for obsolescence that happens for every homeowner in the country. I think the issue is far more complicated and would love to delve into that over. But my first question is a combination between the challenges of illegal immigration and crime. It seems like every single week there's an.
Also, just a reminder, Chart Addicts members, if you guys have any questions at any point, just throw them in the chat and I'll make sure to get to those. If you're on the Zoom, if you're a VIP member, throw up any questions you guys have during this entire thing and I'll make sure to cover those either in real time or whenever there's a break.
Having their hours essentially zeroed out so that the city could allocate more resources for the illegal immigrants. In San Francisco, they say that the average cost between San Francisco and Oakland because of crime is almost $4 billion. Couple that with in New York, you see Governor Hochul bringing out the National Guard and the state police to help reduce the impact of crime. At the same time, Mayor Adams says he needs more money because the state of affairs from illegal immigrants in the city is devastating the economy, scaring the citizens, and reducing the opportunity for.
Again, a reminder that the Fed has nothing to do with immigration policy, has nothing to do with the budget for local cities or states. Literally nothing. It's Congress's job to pass laws about immigration, and they don't do their job. And so they're trying to virtue signal in front of their colleagues and have somebody like Jerome Powell confirm what they've been arguing so that they can kind of gain some credibility. This is not Jay Powell's job. I feel so bad for the people that drag up here. And then they just use it for clickbait to click these little 15, 30-second clips. And they all post it on their social media. You click through, you see, oh, Tim Scott ripping into Jerome Powell for housing costs. You're like, yeah, I support Tim Scott. It's a charade, but there are some decent points that get made through these things. So it's important for us to pay attention.
And it's none of our business. We don't set immigration policy and we don't comment on it.
There it is.
So you commented on immigration. So my point though is that when you're going to tell a story, please tell the whole story, especially when the nation is frustrated by nearly 10 million folks by the end of this year coming into the country and having the kind of negative impact on prices, on crime, on the challenges that everyday Americans, especially Americans living in the poorest parts of America, face on a daily basis.
So as you accurately quoted, I said over time. So I was referring to the history, which with you agreed. So I was staying as far as I possibly could from the current political context. And, it's really not appropriate for us. We're independent. We like to remain that way. And the way we do that, one of the ways is by staying out of political issues that we really aren't assigned.
This is Jerome Powell's catchphrase, by the way. Whenever he's in any hearing, this is not that there's dual mandates that they are assigned, which is maximum employment, price stability, and really just kind of stabilizing the dollar. And none of those have anything to do with setting policy or setting laws. So he has to remind them every single day for the last 5 years. And it's not clicking yet.
Ravishing the poorest Americans has an impact. We don't take that into consideration.
So we do, and so does the Congressional Budget Office. We do try to estimate population, and we try to estimate the effect of immigration, legal or illegal, on the size of the workforce and on GDP. If you look at the Congressional Budget Office has, as you probably know, a detailed assessment of all the things like that. We don't really have a way, and we do look at the finances in the aggregate of state and local governments. That's in the hiring that they do. So that's something we look at, but we wouldn't do a very specific assessment like that. I mean, CBO would, but we wouldn't do that.
Thank you.
This has got Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Before I begin my questions, I want to celebrate that in the past year, we have seen the first Latino Federal Reserve governor and the first ever Latino Federal Reserve Bank president.
Jesus Christ.
These are historic milestones that show we are finally making progress, something that I have been at for quite some time, to the leadership of our economic institutions. So I want to applaud that. And Mr. Chairman, I hope that progress can continue and extend to the rest of the Federal Reserve.
10 million immigrants at the border. Inflation still rising. PCE up 2.4%. Inflation crisis still on the rise. Interest rates at damn near 20-year highs. But we have the first Latino Fed governor. So we can keep printing all the money we want. We can be at $33 trillion in debt. We can have a budget deficit that we have to finance every single year. But we got the first Hispanic Fed governor. Isn't that crazy?
Most robust in the world. It goes on to say, economists and labor experts say the surge in employment was ultimately key to solving unprecedented gaps in the economy that threaten the country's ability to recover from prolonged shutdowns. Would you take issue with those statements?
There are a lot of adjectives and adverbs in there that you wouldn't see in Fed world. But the
Take out the adjective.
Cook them.
the story is, I think broadly
Cook.
that there was a very significant increase in the size of the workforce last year. And it was happening all during the year and we were wondering what it was. And the answer was, it was really two things. It was labor force participation, but it was also immigration. And if you look at the Congressional Budget Office numbers, it kind of makes sense because there was a lot of growth. Wages were coming down. The economy is bigger. And those are probably in part affected. This is without making any judgments on immigration or immigration policy, but I think that's an economic
I'm not
fact.
suggesting that. I'm just suggesting the facts are
Yep.
that we had 10 or 11 million jobs that were going unfulfilled in our economy. They lacked the productivity that is necessary for success economically. And as part of that, clearly, immigration.
By the way, this is a fallacy that people who are on the pro-immigration side love to use, which is the 11.9 million open jobs in the JOLTS report that we were talking about in 2022. That's now dwindled down to 8 million open jobs. They're saying that 3.5 million open jobs has been kind of covered, and we're reducing the slack in our productivity, which is why immigration is a net benefit. That's not necessarily true. You have to look at the composition of the jobs that are being occupied. You have to think about the skilled labor. You have to think about the long-standing effects. And also to whoever said that they should replace Jerome Powell with me, I would rather eat glass than be the Fed chairman. The toughest job in the world. Would not wish that on my worst enemies.
So add to that list
Not me.
underfunding of key HUD programs that shore up and expand our supply of affordable housing. If the housing supply shortage continues to grow, are we likely to see continued housing inflation?
Yes, we are.
And housing is already becoming less and less affordable for low and middle income Americans. According to the National Low Income Housing Coalition's 2023 Out of Reach report, a worker earning the minimum wage in New Jersey would have to work 2 full-time jobs to afford a modest 1-bedroom rental home at fair market rent. Do you agree that increasingly unaffordable housing is a problem for the economy?
I think there are two things going on. One is a longer-term housing shortage, and the other is the pandemic effects and the associated higher interest rates, which are things that will pass through. When all that passes through and rates are normalized, we'll still have the underlying housing shortage, and it's going to be causing upward pressure on housing prices.
Now, the monetary policy report noted that, quote, home purchases by low-income households have fallen disproportionately more because mortgage lenders impose maximums on the ratio of a borrower's debt service payments to the borrower's income.
Mhm.
I'm worried about how this dynamic will interact with the recently proposed capital requirements proposal, which, according to analysis from the Urban Institute, would disproportionately increase.
Also, yeah, by the way, they don't write their own questions, and that's why they're reading word for word. Their staffers write all these, and whoever his staffers are, they did a great job with these questions. Shout out to them.
Implemented without changes, that it could make it even harder for disadvantaged borrowers to attain home ownership.
There is a risk like that, and we're very focused on it.
And hopefully you're working to mitigate it.
Yes.
Thank you. Thank you, Mr. Chairman.
Thanks, Chairman. Senator Rounds from South Dakota.
Thank you, Mr. Chairman. Chairman Powell, welcome back. First of all, I've appreciated the way that you've approached the discussions in front of this committee. And I understand your desire to stay as neutral as possible with regard to the politics involved in an election year. But I do have
But I'm going to ask you a political question.
to the Basil III endgame proposal. An analysis of that
God,
proposal found that 97% were either opposing it or expressing substantial concerns. In the hearing last March on the monetary policy.
By the way, if we get this pullback during this session in the next probably hour or two, then I'll be taking this trade. I think that the best course of entry is 18,121, which will be a pullback to this wick low. And then later tonight, probably during London session, we might get a pullback all the way down to that 18,050 to 18,090 range. Okay, so I'm going to scale entries here. If I do take an entry at 18,121, it will be a small entry. That way, if the market or if price does go into drawdown, then I still have some ammo on the sidelines to re-enter. Okay, so I'm not going to put a full position at 121. I'll scale in, probably put 1/3 of my position here, and then 2/3 of my position at 1890 if the market does get there.
And then making the appropriate changes.
Thank you. As you are aware, I've weighed in several times on the concerns that I have with regard to Basel III endgame, including I'm concerned about the lack of transparency, the negative effects on mortgage lending and home affordability by disincentivizing banks from offering high loan-to-value loans that primarily help first-time home buyers and low to moderate income borrowers. I'm concerned that the proposal will make buying a home harder than it already is for many. And further down the road, I fear that it could disincentivize mortgage lending from the largest banks, particularly with regard to the secondary market and their impact on even smaller banks that do business with them. Would you be willing to withdraw the proposal or re-propose with significant modifications, particularly addressing the concerns that I and others have on this committee, raising specifically with regard to the impact? And I'm thinking of Freddie and Fannie in particular and what the impact might be.
Honestly, solid questioning.
The process involving those particular issues.
So on those issues, we're well aware of and very focused on those issues. We haven't decided what to do about that yet, but we get it on those issues. In terms of process, we're not at the stage of making that decision. I will say if it turns out to be appropriate when we get to that point for us to repropose parts or all of the thing, then we won't hesitate to do so.
Okay, thank you. Makes me feel a little bit better because I do think there are some very serious problems that would occur if the Basel III Endgame as proposed goes into effect. And I most certainly am hoping that the Federal Reserve will find a consensus on this. And it sounds like that may very well include some significant modifications if it were to be brought at all. Is that a fair statement?
I expect there will be material and broad changes to the proposal before it comes back to the committee.
I love this, guys. By the way, this is what somebody who's interested, like who actually cares. This is the line of question. He doesn't care about his 30 seconds of fame, his reels and clips and shit. He's asking the real questions about a specific piece of policy that will impact everybody.
Just the risk.
Well, mostly banks, but the banks will pass on their struggles to us.
During the Biden administration, we saw inflation climb to 13%, and those prices are now the new norm. I know that you make it a policy not to comment on the administration's fiscal policy, but it is well known that I really do believe that high inflation and high prices have been a direct result of President Biden's policies, failed in many cases, that the Federal Reserve has limited tools to address some of the problems that these policies created. We talk about supply side versus demand side on these costs. What have been some of the unintended consequences from raising the federal funds rate as rapidly as you felt that you had to as the chair and as the committee? What are some of those? I know that we talked a little bit about SVP and the failure there, their inability to look at treasuries and the increasing interest rates and so forth. But can you talk a little bit about some of the things that you've seen that were?
And by the way, SVB and First Republic banks, the two regional banks that went under, there's another New York Community Bank just filed for a motion to raise more debt because they're kind of claiming insolvency. It's one of the largest regional banks in New York. And so the bank failures are still coming.
When high inflation comes, it is the Fed's job to restore price stability, and that's what we're doing. You point to the losses in banks. That was a very substantial thing. And obviously the supervisors, and that was us, didn't get to that problem. We were aware of it, but we didn't probably appreciate it enough. Another surprise, though, is that we were able to get this far and get inflation down this quickly without seeing a big increase in unemployment. And that's just a great result. That's just a surprise. It's not.
That's the soft landing, by the way. Getting inflation down without crashing the economy.
The only tools you had available were demand side tools.
Yeah, that's right.
Thank you. Thank you, Mr. Chairman.
Thank you.
Senator Warner of Virginia is recognized.
Well, thank you, Mr. Chairman. Chairman Powell, it's great to see you. I would point out to my good friend from South Dakota, I do think, if we'd gone back a year to 18 months ago, nobody would have predicted a soft landing. And I know you're not ready to declare victory by any means, but the fact that inflation has come down, and I actually think some of the things like the CHIPS bill, the infrastructure bill, and some of President Biden's policies have actually kept the economy growth rate at the levels that have allowed you to bring down inflation without seeing a dramatic rise in
Actually, that was NVIDIA and the ingenuity of American capitalism. It wasn't any specific policies from the executive.
I want to take my time on issues around less about monetary policy and more about regulation. I think we can never presume that we're out of the woods on financial stability, as we saw with the New York Community Bank yesterday, the stock plunge and the capital infusion.
There it is.
One area that I raised with you a year ago, I want to re-raise today, and that is non-bank lending. The fact that non-bank lending in terms of to non-financial firms now is actually exceeding regulated bank lending. And let me be clear, I've got, the non-bank financial sector has done productive things in our society over the years.
It has.
But when folks like former New York Fed President Dudley and former Fed Governor Grosvenor recently said that they had worries about this reliance on the non-bank financial sector could lead to overall economic lack of stability. I guess, what do you think? I've got a three-part question. What do you think are the risks as we see this push-out effect of more and more lending going outside the regulated perimeter to the non-bank sector? How much do we really know about these institutions? And one of the things, they have,
This is what Democrats love to do. Let's justify all the overregulation and then in fact add more regulation, which is like, oh, anybody that's not one of the top 8 banks and we don't know what you're doing, you can't have the right to operate, even though it's legal and constitutional.
So we have the regulated banking system where you've got a lot of transparency, you've got deposit insurance, you've got access to the discount window and all those things, regulation. If you go outside that, most of the funding that we see now in these vehicles is sophisticated investors who are actually limited partners, meaning they can't pull their money out. They've signed a contract, they've funded these deals. And so what you see now in the non-bank financial sector is significantly, it's that kind of thing. So it doesn't have the run risk. The point is, the bigger it grows and the more diverse it gets, it is happening outside the regulatory perimeter. And you worry that when there is another crisis, you'll be surprised, but there will be ways that financial structure too can break down. And it does break down in ways we don't anticipate. So I think we need to be smart about the way, about intermediation is absolutely moving out of the banks into the capital markets and into non-bank financial institutions. That's what's been happening for a long, long time.
Textbook heartbeat model on Bitcoin. Incredible. One more pullback to 63,000. I think this thing is ready for the next leg up to go break all-time highs. Insane. Insane.
until I got a little better explanation recently, why the large regulated banks weren't more complaining about this non-bank lending. But as I got to understand a little bit more of the, and again, I'm not per se criticizing on the non-bank lending, but many of the regulated banks actually lend to these large institutions. So they make, they make money off of those relationships. And maybe that's, again, an explanation of why they're not being more critical. I only got 40 seconds left, but I would like to come back to another thing that we've talked about a lot. And that is the question of use of the discount window. I believe one of the original tools that the Fed had, I know banks say, well, we're concerned about the stigma. I've got some legislation that would actually require mandatory use of the discount window. I'd love your comment on that. And also just the idea that having the mechanics of the discount window open, potentially even 24/7, because we saw with SVB, they didn't know how to use it, but two, if they wanted to use it in the non-bank hours, could they get access?
There's a lot of work to do on the discount window. You're absolutely right. It needs to be brought up technologically into the modern age. We need to do more to eliminate the stigma problem, and we need to make sure that banks are, actually able to use it when they need to use it. And those things. That's a broad work program that we're on right now, and it's very important.
I know you're working on it, but I would look forward to working more, and I'd invite other colleagues. I really do think before we start adding a whole host of the other regulatory issues, we ought to use some of the tools that are out there. You're not gone. So
I checked in at the Veterans Committee. Senator Tillis, North Carolina. Thank you, Mark.
I was about to take control, Senator Warner. Welcome, Chair Powell, and Gus sends his regards. If you have time after the hearing, you ought to go by and see him. He's a dog in our office. But
I don't want to disturb his nap. But
but thank you for being here. I want to get back on this Basel III proposal. Senators Lummis, Coons, Gillibrand, and I sent a letter indicating our concerns with the current proposal. But I think it's also worth noting that the number of other organizations, a diverse group that are not normally aligned on policy. You got Bank Trades, National Housing Conference, NAACP, Habitat for Humanity, National Community Reinvestment Coalition, the list goes on, who have concerns with the
all liberal, mostly Soros-funded organizations.
I think we're trying to make the best of what was foundationally a bad proposal. And so I'm in the category of...
So what's up with gold? I got stopped out 3 times. You're trading news with one of the most volatile instruments you can trade and wondering why there's so much volatility.
Before he ever got confirmed on the board that we were going to be in this place some months or years later. And here we are. And I think that the industry felt the same way. All of these stakeholders, some of them are in banking trade, some of them are on the other side of the spectrum. So I'd like to cast my vote or provide some weight to the idea that we should repropose it. And what we ought to do is talk about the reality of increasing capital, or the prospect of increasing capital requirements doesn't concern me. I think the prior Fed supervisor had made comments publicly that maybe we needed to raise capital standards. But what we did here in this proposal, and I heard in that dialogue, is let's deal with puts and takes. Let's talk about raising capital requirements, but let's also talk about reducing the cost of the regulatory burden today if we can do it responsibly. There's no evidence of that in the current proposal, and I think that may actually produce a different set of comments that would be instructive to a final proposal that I think realistically will include some increase in capital requirements. So over what time horizon do you think we would expect to either try to make the best of this foundation or go back and take a look at a new foundation and repropose it?
You know, we're going to work through it as quickly as we can and should. I will say it's more important to get it right than it is to do it fast. We're not in a hurry.
Agreed.
But my guess is we'll work this out over the course of this year.
Yeah. Well, if you take a look at the outsized cost of operational risk, the long list of concerns that I have publicly and privately expressed on the current proposal, I do think sometimes it's easier to knock down what I think is a poor foundation and build a better house. So again, just wanted to make that comment publicly. I got a question about shrinkflation. I tell you, some of these words that we come up with, but President Biden's using the idea of shrinkflation and chastising manufacturers for creating smaller portion sizes for potato chips. I'll use that as one example. But if you have rising input cost, and you're not able to control that, and you're in a marginal business to begin with, and now you're saying you can't even reduce the quantities. How does a business that's not making a profit make that work?
You know, I mean, we see inflation at the aggregate level as a mismatch between supply and demand.
Yeah.
And as we've seen supply get better and we've seen demand cool off a bit, it was very hot coming out of the pandemic. We see inflation coming down.
We saw food inflation between 2010 and 2021 at 18% over 11 years. And over the last 3 years, we've seen it at 21%. I think that we have a industry that's trying to actually provide products that consumers want, chastised for trying to figure out how to make the numbers work. So this whole idea.
I mean, in case you guys aren't following along, there's only two ways for a company to make more money. So a short example is Colgate back in the late 90s was trying to figure out how to make 10% more profits. And what they ended up doing was they reduced they increased the size of the nozzle at the head of the tube of toothpaste by 10%. So people were just naturally pouring out more toothpaste and they were buying more toothpaste at a faster rate. And that's what increased their profits at the time. That's what they're kind of talking about here, is that if you can't bring down your costs of making this stuff, they can either raise the prices for us or they can reduce the portion size, which is what we've been seeing everywhere.
May have said.
Well,
I'd like to avoid that.
I don't think, I'm not going to ask you about policy because I think you're consistent on that, but I just can't imagine that if we decided to outlaw stock buybacks and dividend payments, that would have a material effect on inflation. So I'm not going to ask you to respond to that, but there are some people that by inference, you could assume that they think that would be helpful. I just, for one, I'm not an economist, but I just can't imagine that it would be, one of the things that would make your job easier. Can you at least opine on that?
Banning stock buybacks and dividends?
Yeah.
Yeah, I think that would be quite a change in our cap.
Bro,
Yeah.
what kind of stupid
shareholders-
proposal is that?
This is just money going back to shareholders from.
That's probably an AOC suggestion.
Mr. Chair.
Well done, Senator Tilton. Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. And thank you, Chair Powell. It's great to see you here again. I appreciate your testimony. And I'm going to focus my questions on housing and housing affordability. As you have well pointed out, overall prices have moderated considerably since the Fed began raising rates, yet housing costs have remained stubbornly resilient or high, leaving us really no closer to addressing the affordability crisis that I think that we have, and this was there well before the pandemic. Shortly before the Fed began tightening, Chair Powell, and you came before the committee, I asked you about how higher interest rates could exacerbate this unaffordability problem that we have by making mortgages more expensive and also hindering housing development. And I think that at the time you argued that we have a excess housing demand during the pandemic.
Whoever said something that there shouldn't be any women in this room, brother, most people in this room could run circles around you. All right, so this is not a male or female thing. This is corrupt versus non-corrupt. You're either bought or paid for, or you got elected. You're here. You're new in DC. You're representing your people, and those are the differences. There's some very competent people up here, but then there's some very corrupt people up here as well.
Tool.
So let's not use this as a chance to, bring sexism into this. Don't be a clown.
All that you can to lower housing demand. My view is that we're well past time in Congress to take action on the housing supply side, but I'm interested in how you see this dynamic.
So we're not focused so much on housing and housing inflation. We're really focused on the aggregate, which is also
Yep.
goods and not housing services. That's way more than half of the PCE inflation. There are things in the housing sector that we didn't fully anticipate. One of them just was that people in very low interest rate homes with very low interest rate mortgages aren't selling.
Right.
So the quantity of homes that's available is incredibly low, and that's why it's very little in the way of existing home sales.
And keep in mind that over 80% of the residential mortgages in America are under fixed rates, which means they were unaffected by the interest rate changes. It's only new home buyers that have been affected or folks looking to refinance. And so the adjustable rate mortgage people that were affected, that's the issue that the government and the Fed has to deal with. Mostly the government, not really the Fed.
And get better, and housing affordability should go up again. But you're still going to be left with the longer term problem of supply.
Right. I think that's right. I mean, what I see in Minnesota.
Also, if you guys have learned anything or you guys have taken any value away from this stream, just drop a like real quick. It takes 2 seconds just to hit that thumbs up. It'd be appreciated.
A house that maybe is a little too small for them because they can't afford it, that the housing, just as you're saying, people are staying in their homes longer. And so there's sort of this double whammy of construction slowing at the same time that there is this great need to address housing supply. One of the things that, is happening, it's interesting, a recent analysis by Zillow found that the monthly mortgage payment let me get this right. A recent analysis by Zillow found that the monthly mortgage payment on a $343,000 home, assuming 10% down payment, is about $2,200 a month. Okay, so $2,200 a month. That means the cost of owning a typical home is higher than 30% of median income, which is kind of the measure of affordability. And so we've got a lot of issues with people just the home of the housing market. So from where I sit, the cumulative issues of higher mortgage rates are just really a challenge. And until we can get to the bottom of that.
By the way, just for the sell side, I told you guys that 250 zone was going to be the rejection. I think it's probably going to push through just a little bit. And then we might see the correction during this session. I kind of have this feeling that we're not going to see the correction all the way down to re-entry until probably London session, or maybe even before that, maybe during Tokyo. So, if we're lucky, we get this pullback to 121. If not, then price is going to break through, consolidate for the majority of the session, and then we'll get that pullback later at the very, very end of the day. All right, so just a heads up of what I'm seeing here on the charts.
Mr. Chairman, thank you.
Oh, this guy is a character. Mr. Kennedy is looking for his 10 minutes of fame, and he's just looking for fame. I don't know what his deal is, but he's freaking hilarious.
Probably saved the world economy during the pandemic economic meltdown when the whole world wanted dollars by establishing the currency swap line. So I thank you for that. You gave an interview, Mr. Chairman, on February 4th of this year to CBS, 60 Minutes, I think. Is that right?
Yep.
I ordered a transcript of that hearing, which I read. I learned a lot reading it.
Yeah, that 60 minutes interview, we covered it on the live streams. That was something else.
About inflation. And you ask a question about prices declining. And here was your response. I'd like to quote you, if that's okay. Quote, so the prices of some things will decline, others will go up. But we don't expect to see a decline in the overall price level. That doesn't tend to happen in economies except in very negative circumstances. End quote. Did I quote you accurately?
I believe you did.
Okay. Later in the interview, you were asked about the national debt. Do you recall that?
I don't actually, but I'm sure that's right.
Okay. Well, at least according to the transcript, your answer was, and again, I'm quoting you, in the long run, the United States is on an unsustainable fiscal path. The U.S. federal government's on an unsustainable fiscal path.
Guess whose fault that is? Guess who's been in Congress longer than everybody here?
So it
Lord
is
have mercy.
unsustainable. End quote. Do you remember saying that?
I've said that many times. I think that's uncontroversial.
Okay.
Well, I love Jerome Powell, man. I don't care what people say about him. By far the best Fed chairman we've ever had.
I would just say this, integrity is priceless.
Paul Volcker might have something to say about that, but Powell's close second.
We plan on keeping ours, end quote. Is that an accurate statement?
Yes, it is.
Okay. That's why I want to ask you about the FDIC. Have you read the article in the Wall Street Journal entitled, quote, strip clubs, lewd photos, and a boozy hotel, the toxic atmosphere at bank regulator FDIC, end quote.
All right, hold up. First off, where can I apply? No, I'm joking.
Entitled, I quote again, FDIC lawyer stayed on paid leave for weeks after child porn arrest, end quote.
All
I
right,
don't remember that
pause.
one.
Okay, did you read the article?
First off, if everyone's not aware, the FDIC is the Federal Deposit Insurance Corporation. They're kind of the insurance policy for banks. They insure your money up to $100,000. And so if the bank goes under, the government will pay you $100,000. Now, in case you guys don't know, the FDIC is actually bankrupt. They could not afford a bank failure, which is why the Fed opened up something called the Bank Term Funding Program to pump liquidity into the banks. And that facility is still open, due to end in a week.
Called her male colleagues saying women needed to use sex to get ahead at the FDIC?
I do not recall.
Okay, this is crazy. The FDIC is one of the most boring places in the world. The fact that they're talking about all this shit is insane. I haven't heard any of this.
Examiner during a lunch with a male examiner said she had become friendly with that examiner, and he complained to her about his marriage, allegedly, telling her he wasn't getting enough sex. And she allegedly said, quote, obviously, if I walk, or he allegedly said, obviously, if I walked into this office and you were naked, I'd fuck you right here, end quote.
Lord have mercy.
Remember that, and I think I would.
Okay. Do you remember the article?
Yo, so okay, Kennedy is reaching for his clout right now. This is insane. He needs to get a grip.
Put it in 2014 to a non-supervisor.
Because the FDIC is a function of the Treasury Department, which is overseen by the Congress, not the Fed. The Treasury and the Fed are independent. The Treasury is the piggy bank of the United States. Okay, they're directly a part of the government. They're a branch of the government. The Fed is a private agency started by commercial banks, and it's supposed to regulate the dollar and supposed to be independent of any political influence. So I don't know why he's asking about the FDIC corruption. They should bring Janet Yellen up here, their buddy, and question her about that.
Senator Kennedy, your time's already expired. You can do one. You did 5 minutes, consume the whole 5
Look how uncomfortable he looks.
monologue of,
Well, you did 6 minutes. I timed it.
I asked my
You did 6 minutes.
Senator Kennedy, for months, I have let you go way over the 5 minutes. You get your question,
But you did 6 minutes.
Fight.
You still did 6 minutes. Check.
It's like watching toddlers argue. This is ridiculous.
minutes and 15 seconds if you continue this argument,
Well,
or
that's-
you're going to ask your question.
I'll ask my question. I just wanted the record to be clear, Mr. Chairman. Mr. Chairman, in light of these allegations, if they're proven, how can the FDIC,
Yeah, I timed it is crazy.
which is going to turn the banking community upside down?
I don't know how I would make the connection to Basel III. I'll say this deeply troubling things, obviously, but again, you know, as your point was, if proven. And I mean, I think we have to decide Basel III on its merits, and we're not looking to the FDIC to lead this, by the way. We're looking at the Fed to do what the Fed thinks is right. That's what we're going to do. We don't look to, and they don't look to us to lead them.
Thank you, Chair Powell. Senator Butler is recognized.
Thank you, Mr. Chairman.
Thank you.
Senator Butler is recognized.
Just wasted all that time talking about 6 minutes, and he used it to ask a bunch of useless questions. God help us, man. If you guys want to ever wonder why nothing gets done in this country, watch these hearings. You will get a very clear idea of who is in charge and who we're voting into these positions. All right, that's why voting matters. They convince you voting doesn't matter, and then all the old people come in. They vote. They vote for these people, and you know that this is what happens.
At least according to the California Department of Housing and Urban Development, renters in San Diego are paying about 50% of what is, they're spending more than 50% of what is considered affordable. And statewide, the majority of renters, more than 3 million households, are spending more than 30% towards rent. Nearly 1/3, more than 1 in 5 million households pay more than 50% of their income towards rent. And the Chicago Fed President Goolsbee even referred to housing as a missing piece of the puzzle in the Fed's path to lower inflation.
This I actually agree with.
To the continued conversation, and I know a point that you've made that about how inflation has a disproportionate impact on lower income households who are focused on spending more of their monthly budgets on housing. How is the Fed's monetary policy impacting the supply of affordable rentals?
Good
I
question.
don't know that we're affecting the supply of affordable housing. If you think of
All right,
affordable
that's a
housing
BS
as
answer.
something that's connected to some sort of government program, that's not our bailiwick. I mean, clearly interest rates do affect the affordability of housing though.
Okay, so he's like, oh, we don't affect it, but we affect it. The interest rates affect housing. The mandate of price stability means that it is the Fed's job to keep the largest part of all of our budgets stable. And so people pay the majority of their incomes on housing, and then the rest goes to food, water, energy, and other things.
To think about housing inflation, do you include the costs of financing it? Do you include the sale prices? And the answer is we don't. We convert ownership into an imputed rent, and that's 2/3 of homes are owned. And then we actually measure rents, but leases only turn over once a year. So you look at market rents, and what's happening with newly signed leases may be very different from what was happening a year ago. So it's complicated, but the good thing is we understand all that, and we look through that. We look at housing services overall as one of the 3 important categories, along with non-housing services.
The way they measure rents, by the way, is also very flawed. And the way that they include housing in CPI is an absolute sham.
Kind of affordability and how.
They're trying to avoid responsibility, basically.
Role, I think, to the broad monetary policy and state of our economy and unique to California. And I raised this with Secretary Yellen when she was here as well, the insurance gaps that are presenting themselves due to the impact of climate change. And where 1 in 5 residents in California live in areas of that risk flooding, and all 58 counties have a history of flood damage. And we are seeing more and more insurance providers, home insurance providers, actually withdrawing from the state. You and I had talked a little bit about this in our our preparation for today's conversation. Can you talk to me about or share with us how it is that you, or what you think the impact might be of this sort of protection gap in insurance coverage on the overall stability of financial institutions in the broader economy?
So it is clear that insurance of various different kinds, housing insurance, but also automobile insurance and things like that, that's been a significant source of inflation over the last few years. And it's to do with a million different factors. It's nothing that we control from a regulatory or supervisory standpoint. You know,
All right, I'm gonna pause this because he's kind of just running around the answer. The Fed does have an effect on housing. If you don't think so, try to go get a mortgage today and see what the interest rates are. And then typically when interest rates go up, housing prices go down to compensate. But the biggest issue that BlackRock and buyers of last resort are keeping an artificial floor on the housing market by buying up residential real estate, bank distressed properties, and other low priced residential properties, kicking the average citizen out of that market and taking the lion's share for themselves. And so that's why housing prices have remained elevated despite high interest rates. Also, there's no way that Mike Tyson and Jake Paul fight is actually real. Are they actually doing that? That's crazy. I'm excited to watch the Francis Ngannou fight, and I'm excited to watch the Michael Venom Page versus Kevin Holland fight. Those are the two fights I'm very, very excited about. Side note.
Back to sort of one of the most significant crises, obviously, in our banking sector, of course, the collapse of SVB and First Republic. You and I have spoken in private and I believe in public, but one of the concerns that I have is when we talk about increasing capital requirements on the banks, if the banks were under higher capital requirements in the run up to the crisis, there's maybe an argument that SVB, for example, would have bought more long-term treasuries, which would, of course, would have exposed their balance sheet to even
This dude got an army behind him.
Bond risk. And that, of course, would have maybe hastened the collapse of SVB. And I guess I want to start here with, when we talk about, some of the Basil regulations, what was the original intent? In other words, what was the original sort of proposal for which banks would fall under those regulations and which would escape them?
you mean this time around or I mean earlier on?
This time around.
So it's the 37 largest banks. It's down to, well, there's four categories of banks, including the G-SIBs, and this is down through the fourth category. The proposal that's out there now, I think, does extend to category 4 as well as 3, 2, and 1.
So what's the minimum assets under management that you guys have proposed the current Basil regulations?
100 billion.
100 billion.
Yeah.
And sort of that sort of gets to my concern here, because I know there's some discussion about whether you apply them at $700 billion of AUM or $100 billion of AUM. And maybe you could just sort of walk me through that decision process at the Fed, where you guys are and what would sort of justify drawing down from a $700 billion threshold to a $100 billion threshold.
So there's the G-SIBs, there's the 8 identified G-SIBs, and then there's one category 2, I guess, and then there are the big regionals, and those tend to be, well-known big regional banks, and they're category 3, and one of them's a 2, I guess, but they have a different tailored level of regulation. And then category 4 had significant tailoring. And the question is, we have to ask the question, since SVB was a category 4, we've got to ask the question, what, if anything, needs to be changed in the way they were regulated, supervised from a capital and liquidity standpoint. So there was tailoring all the way down. And then below 100, of course, those are community banks, and that's a different regime as well.
So capital requirements is the amount of money that commercial banks are required to park at the Fed. This was done after the 2008 crisis. Some of you guys might know this, as a kind of an insurance policy for the banks not having enough money on hand to take care of deposits and to take care of mass withdrawals if there's a bank run happening. So the capital requirements have kept the banking system a lot more resilient. But like he said, there's different requirements for the regional banks versus the big 8, kind of like the Wells Fargo's, Bank of America's, and Chase and the rest.
Fits to our economy. And you hear a lot of people talk about the American economic miracle, and I do wonder if part of that is because we don't have the same type of financial system that has sort of dominated in Western Europe and in other first world economies. I'm curious, in the process of amending the Basil requirements, I mean, have you guys made a decision about where to set the threshold yet? And when do you expect to set that threshold?
We haven't made any final decisions. We put out for proposals some
Right.
months ago, a proposal, and we've gotten a lot of comments, as I'm sure you're aware. We're chewing through those and digesting them, and we're just beginning now to sit down and talk about the changes that will appropriately make to the original proposal.
And when do you expect to sort of issue a final proposal?
I think it's going to take some time. I think it's more important to do it right than it is to do it fast. My guess is we'll get through this.
The next time I'm late on a project, that's exactly what I'm going to say. That is exactly what I'm going to say.
So I'm wondering, just being mindful of time, I have about 30 seconds left. Would you be willing to commit to say that in the process of amending, the Fed will remove the regional bank drawdown and limit Basil's application directly to the G-SIBs or $700 billion or above?
I can't get that specific at this point, but we're clearly looking at the whole tailoring issue.
I appreciate that. And again, I just repeat, Chairman Powell, given what actually happened with the banking sector with SVB and First Republic, I just encourage you guys not to apply a regulation that doesn't actually solve the underlying problem. And I fear that if you apply this to banks of $100 billion and above, you actually are doing just that. So with that in mind, I'll yield. Thanks, Mr. Chair.
Thanks.
So he's like, yeah, don't just put these rules on the big guys, because then all the little banks are kind of scheming around, and they're the ones who are at the biggest risk, and taxpayers have to bail them out. So I think that he makes a good point. He's got an army behind him. The solid line of questioning there, but yeah, bank failures is a huge deal because they've pumped close to 190 billion or $200 billion into the banking sector through the Bank Term Funding Program, which kind of undid a lot of the quantitative tightening that the Fed was supposed to be doing to pull money out of the economy. So at the same time they were supposed to pull money out, they've been pumping money into these banks through, it's a loan program, so they have to get paid back. But just the whole fact that the Fed can just print money or use their balance sheet to bail anybody out at any time. Now they're looking around at all the structural dangers, and they're like, okay, if any of these things crash, what's going to be the total cost for the Fed? Because they're going to step in. And now we're thinking, oh my God, like this is going to cost us a lot of money if there's a systemic bank failures going on, just like New York Community Bank that was just mentioned.
And the core number is at 2.8. I think it was at 4.9 a year ago. So these are big declines. So we're in a very different place, in a healthy place. We're going to use our tools to try to keep that strong economy, keep that strong labor market while we continue to make progress on inflation.
One of the areas where there has been inflation, and I don't exactly know where it's at now, but food rose quite rapidly. And by the way, I'm a farmer. We didn't get much of that. In fact, we didn't get any of it. Prices now compared to what they were a year ago are actually off. Compared to where they're 6 years ago, they're up. But compared to where a year ago, they're down. And so my question to you, Chairman Powell, is there anything you can do specifically to deal with food costs?
So as I'm telling a farmer his business, but if you look at the food cost to the consumer, part of that is commodity costs. And that was partly spiked because of Ukraine, grains and oil and that kind of thing. But the rest of it is a lot of costs in the supply chain, from when it leaves the farm to get, collected and processed and trucked around and then put on the shelves and then the stores, and all of those costs are just part of the general economy. So as the labor market cools off from its overheated status 2 years ago, you will see, and you have seen, food inflation flattening out. And so, the really...
He's out here complaining, but it's like at the end of the day, consumers are getting a better price, because a year ago, inflation was damn near 9%, or going into the year, we were at about 5.5. So this is good for consumers that, the price at the grocery stores are coming down. This guy's like, well, farmers didn't make as much money as everyone else. Like, how can we fix that? Buddy, keep the costs where they are. Reduce... Fed Powell, or Chairman Powell, was basically saying the inflation is being caused by the supply side. So the transportation costs, the supply chain backups between all the different conflicts in the world, and then obviously the embargoes in the China Sea, or the South China Sea, and some of the problems between Saudi Arabia and the Houthis. It's creating a lot of supply chain problems, getting food and getting other supplies around to the rest of the world. Those supply chain costs all added up created the higher cost that farmers are paying. which is why their profits have been dwindling. Because, you know, the price of produce is coming down. They're not making as much money. And so the only thing they can do to make money now is to reduce their supply chain costs.
Economy. Yes.
Yes, okay. Look, one of the other challenges out there is housing in communities all across this country, whether you're in Montana, whether you're in a city in Ohio.
All right, I don't know what he's talking about. Two quick reminders. Number one, grab your tickets to the FX Summit 2024 conference in Dubai. It's gonna be November 15th to the 17th. So if you've never been to Dubai, this is gonna be a great way to go experience the city because we're gonna be kind of doing our thing there, and it's gonna be a chance to experience it at a very high level, doing something incredible, a lot of influential people. This is a way that you want to visit a city, you know, kind of go there with some clout and something to do. Another reminder is that today is the first day of the Trading Psychology Boot Camp, 3-day boot camp to get your mind right, not just for trading, just all around. But we talk about trading psychology all the time. Everyone agrees it's the #1 hurdle for traders, but nobody ever goes out of their way to commit to mindset. They'll pay for courses about technicals. We all pay for courses for fundamentals, everything in between. But when it comes to mindset, everyone's like, no, I'll get to that later. And then it continues to be the recurring problem. And that's sort of the thread between all the issues in our life. So if you're looking to get yourself on track for 2024, get back on track, hit those New Year's goals, and potentially even exceed your expectations for what's possible for this year, 3-day masterclass, full mindset bootcamp. Last day will be focused on trading psychology. Head over to the link in the description to get your seat.
Weighing on the housing market, but as rates come down and that all goes through the economy, we're still going to be back to a place where we don't have enough housing.
Well, once again, thank you, Chairman Powell, for your work. I very much appreciate it. Thank you, Chairman
Thanks.
Brown.
Thanks, Senator Tester. Senator Kramer of North Dakota.
Thank you, Mr. Chairman. Chairman Paul, good to see you. Thank you for being here. It's been a rather uneventful.
By the way, if you're watching this, mark off these levels on your chart. They might not hit during this session, but these are the same exact prices that I will be buying from in the next session, potentially tonight in the London overlap. So just because it doesn't happen during the session that you're watching does not mean that the trade's invalid. In fact, this is actually going to confirm the trade the longer that we consolidate here during New York. So mark off these levels. If you're going to trade it, fine. If you're not going to trade it, at least you have something to watch and learn so that you can develop your perspective of how these markets work.
Similar to what you said probably to Senator Scott. But that said, in October, the Fed, the OCC, the FDIC issued climate guidance, as you know, for management of covered institutions. And so I'm just kind of curious, did Congress somewhere along the line give the Fed authority over climate policy as well? Or is that another one of those things that somebody just took on? And I realize you're not the dictator of the Fed, only the chairman of the Fed. But I'd be interested in, as the chairman, your views on.
Our assignment is the safety and soundness of banks and that they understand and can manage the risks that they face. That's our assignment. And we said in climate world, we would do two and only two things. One of them was to do illustrative stress scenarios, not stress scenarios, climate scenarios, so that, the banks are already doing this. The large banks who are subject to this, they're already doing it because they're doing business internationally and they don't have any choice. So we said we'd do that. And we also said that we'd offer guidance on not on level of climate risk or anything like that, just on what you had to do to be in a position to assess. And that's, for my thinking, that's it. That's what we're doing. And we're not doing it. There are no new initiatives. We're not going to change our capital requirements to reflect climate risk or anything like that. I'm really determined that we are not a climate policymaker and that is really the business of elected officials.
Oh, thank God.
Very good. Thank you. I'm going to bring up one other topic. I don't know that's been brought up today, and that's central bank digital currency. I think from a lot of my friends out there, I think there's I know there's some confusion. I mean, I'm easy to confuse, but there are a lot of people that get confused about what is meant by the administration's, admonition to continue researching, experimenting, looking at some sort of a, central bank digital currency. I think people back home look at that and go, oh my gosh, they're going to control this now. And could you maybe just differentiate a little bit what people think of in terms of a Bitcoin or their held digital currencies versus what a central bank digital currency, who, in my view, should emulate cash, right? It still should be about the dollar, not about some different kind of currency. Could you just sort of help people back home better understand why they shouldn't be quite so frightened?
First of all, I want to say that we're nowhere near recommending or let alone adopting a central bank digital currency in any form. But
Whoa, 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 whoa. Hold on. What? Did you guys just hear that?
hold on, the government doesn't issue digital money. It's digital. If you look at your bank account,
Whoa.
people don't hold those physical dollars. They're digital. So the thought was that the government could create a digital form of money that people could then transfer among themselves. Now, of course, that
Hold on. Whoa. Pause.
if that were a government account, that the government would see all your transactions, and that's just something we would not stand for or do or propose here in the United States.
That's the first time Jerome Powell has taken a hard stance against CBDCs. That's huge.
We're a very long way from even
dollar is about to pump
through the banking system. The last thing we would
This has to be bullish for the dollar. That's huge, guys. I'm gonna do a whole video just on that.
or any Americans for that matter. Only banks have accounts at the Fed. That's the way we're going to keep it. So it's just really, it's a question of following technology as it evolves and in a way that serves the public better. People don't need to worry about a central bank digital currency. Nothing like that is remotely close to happening anytime soon.
That was very helpful. Thank you, Mr. Chairman. Thank you, Chairman.
Wow.
Senator Cortez Masto of Nevada is right.
Thank you, Mr. Chairman.
It's 11:17.
Chairman Powell, great to see you again. Thank you for all of your good work. I want to talk a little bit about the commercial real estate and what's happening there. The financial.
Guys, expect to see that all over the news. Expect that headline to be one of the bigger headlines from this hearing. This, first off, this makes me very happy. Okay, but it's also, I don't know, he kind of worded it funny. He said that the CBDCs is nothing that we would ever support. Like, we're going to create digital money to send around, but like, it's not a CBDC. Okay, let's see what that means, because they did have a white paper available and they were running a beta test, I think in 2024, to see if CBDCs is something that could work and something that the market would accept. God, this is good news.
At banks with large CRE concentrations and high fractions of uninsured deposits.
That gold shorts, I would hold off on shorting gold until the dollar rebounds.
In commercial real estate right now, particularly in the troubled areas. So it's not a question of prices still falling. It's a question that you don't have the kind of price discovery. You just have to assume that the prices are very low and have come down a lot. So on commercial real estate, we have a secular change in people working from home. This is one big part of it. That means that in many cities.
This is kind of what I'm seeing here, Walter. I'm seeing phase one. Okay, then we have phase two, double bottom, 88.6, 886 retest from the recent impulse, double bottom, push back inside. And the question is, did we close above the low? Okay, so if we hold above the 2154, I think we get one more retest and a push up to the 2160. Again, I don't trade gold, so take that with a grain of salt, but that's what I'm seeing. Put something in the chat, guys, if you guys see that, if you're in the Zoom call, if you guys see all three phases here. Yep. And you guys see that took about 15 seconds, right? Once you know what you're looking for, you can't unsee it. You will never unsee it. All right, good work, guys.
Have concerns. Let me just ask you this. As you're talking with these small and medium-sized banks, because we know that there's always could be a contagion, which we've seen in the past. Do you have concerns that if they fail, that somehow this is going to impact the financial sector? And are you prepared and trying to address that and prevent that from happening?
We're trying to stay ahead of that. So we also reached out to banks that had high concentrations of uninsured deposits, and particularly uninsured deposits, and a lot of commercial real estate in the office sector. So we're well aware of that issue, and we're just trying to stay ahead of it on a bank by bank basis and overall.
Okay,
And so far, we've been able to do that.
thank you. Let me jump to another issue that has been on my radar. The Federal Housing Finance Agency's report on the federal home loan banks concluded that the distinction between the FHL bank's role and that of the Federal Reserve discount window as lender of last resort has not been clear, especially during times of market stress. During the 2023 banking turmoil, we saw banks rely on advances from the federal home loan banks and didn't even have relationships with the Federal Reserve to use its discount window. I know you've talked a little bit about this with Senator Warner, but how is the Federal Reserve working with the federal home loan banks to ensure that banks establish protocols to borrow from the Fed's discount window prior to times of stress?
We work with the federal home loan banks because in many cases, banks were moving their loan from the federal home loan bank to the Fed. So we need to have smooth transfer. We need to be in good touch with them. Even more important than that, though, is that banks, any bank in the United States, needs to be in touch with the discount window, know how to be able to access it, be able to access it, have appropriate collateral, have control of that collateral. You know, in many cases, it was incredibly inefficient and took a long time for banks to actually go through that function. The federal home loan banks are actually ahead of us in technology. We know that we need to really invest in technology to modernize the discount window, and also we need to do more to get our banks, all of them, in touch with the discount window in a way that they can use it quickly should they need to do so.
Thank you.
Cortez Masto, Senator Haggerty of Tennessee is recognized.
Thank you, Chairman Brown. Welcome, Chairman Powell. Under your tenure, Mr. Chairman, the Fed has taken the stance that the 2% inflation target shouldn't be viewed as a snapshot in time, but rather it needs to be achieved, quote, sustainably. When inflation was running well above the 2% target back in 2021 and early 2022, the Fed was patient and allowed rates to offset the below target inflation that had occurred in the years prior.
So this is a concept I wanted to talk about at the end, which is the FATE program, the Flexible Average Inflation Targeting, which basically Jerome Powell had a shift from targeting 2% inflation to having this flexible average, meaning some years you can be below, some years you can be above, but as long as it smooths out to an average of 2%, we'll be stable. But then he just shifted his tune yesterday where he was talking about basically like they were only doing that when inflation was below their 2% target. But now that it's well above, they don't really care about the flexible average, which is a huge shift from 2 years ago.
Really get comfortable that inflation had settled in sustainably at 2%. But that's not our test for changing interest rates. Interest rates right now are well into restrictive territory. They're well above neutral. And we've said we would not wait for inflation to get down to 2%, because if you wait that, monetary policy works with long and variable lags. So we've said, for some years that we would start restoring the federal funds rate to a more normal, almost neutral level. We're far from neutral now.
Yeah.
And so, we do plan, assuming the economy moves along the lines we expect, we do plan on starting the process of dialing back restrictions.
I'm just trying to look for the symmetry. I know we sort of allowed the economy to overshoot when inflation was high. And we sort of made up for prior years of low inflation. I'm trying to square that with the fact that
we didn't actually do that. We adopted a framework that said we would do that, but then we got suddenly a few months later, we got almost an explosion of very high inflation. That's not what we were looking. We said, moderately above or modestly above 2%. This was not modestly above 2%. And we reacted. We thought that the mistake we made was we thought that inflation would go away.
That it was transitory.
Which means it goes away quickly without effort by us. We figured out at the end of 21 that was not the case, and we acted.
And you don't see that same abrupt dynamic coming the other way. You're more comfortable.
No, I think we're in the right place, which is we're waiting to.
That's such a hard question. That's the question. That's the $1 trillion question right now.
When we do get that confidence, and we're not far from it, it'll be appropriate to begin to dial back the level of restriction so that we don't, drive the economy into recession rather than normalizing policy as the economy gets back to normal.
Yeah. Can we go to the balance sheet and talk about that?
This is so good. This Haggerty guy is straight to the point. You can see he's not reading off of a script.
It was at $800 billion. It's at 7.5 trillion today. It's doubled since the pandemic was underway. And through quantitative tapering, the Fed is attempting to reduce its footprint. And the concern I have is, on the other hand, government spending tends to just continue to be profligate. We're running now $1 trillion deficit every 100 days. And we're flooding the market with treasury debt, and we're putting upward pressure on interest rates as a result. And what I think that is lost on many of us here is that the spending levels will only make your job harder when it comes to lowering interest rates, not to mention there's a tacit expectation that the Fed will step in.
Yeah, it doesn't look like we're going to get this pullback until later in the session, just a heads up. So buying into the trend this late as it's about to hit targets, not a smart move. So personally, I'm going to wait until price retraces back to a discounted level, which is likely to happen either the second half of New York session or during Australia, right? Or Tokyo.
Could lead to modestly higher rates, but that's not going to affect what we do. That's not a problem for us. Our balance sheet normalization is running very much as expected. We've decreased the size of our holdings by almost $1.5 trillion.
I hear you. I think it's troubling that we continue to put fiscal pressure by continuing to put, again, we're running a deficit of $1 trillion every 100 days, and the issuance is required to deal with that. But putting a lot more pressure, I think, on the Fed, and again, making your job harder. I think we need to take that into consideration. Another component of this topic.
Did he just say they're running
the Fed to shift its
$1 trillion deficit every 100 days? That's $3.5 trillion a year in deficits, by the way, that the Fed is financing through printed money.
Securities holdings. Do you share the goal with Governor Waller? And if so, how long will it take us to get there?
Take a while. That's an issue. We're in our FOMC meeting in a couple of weeks. We're going to have our first really deep dive on what to do with the balance sheet. That's one of the issues. I don't think we'll deal with that at this meeting.
Wow.
Over time, you'd love not to.
I hope you jumped out of those gold shorts. Because wow, straight to TP. Quick 40 points there. Looking for another, looking up to 2160, potentially even higher, up to like 2163, maybe this double top right here. If it breaks the double top, then it'll come back for a correction to 2157. If it makes a lower high, it'll come all the way back down to 2154. So 2163 is the next target, and then we'll see if it breaks or bounces from there. Dollar is dumping off. The reason that the dollar would dump off is if the market is just basically valuing risk assets and safe havens and commodities more than just holding cash. So you guys can see stocks are pumping. Crypto is back pumping. And obviously gold is moving. So that's where the money is going. It's always follow the money, FTM. And if you can see the dollar dropping in value and then other assets are dramatically rising, it means folks are getting off of cash and really looking to take on some more risk. Now, there could be a million reasons for the correlations, but this is just the general correlation. Back to the show.
Banks, only the banks.
Oh, God. Do you guys want to hear Senator Warren, or should we just skip this part? What do you guys think?
Now, Chair Powell, when you testified before this committee last June.
Yeah, and that gold analysis took about, I want to say, what, 15 seconds, 30 seconds?
The main responsibility I take is to learn the right lessons from this and to undertake to address them so we don't have.
I think she got a thing for Powell, man. That's what I'm thinking. I think she got a thing for Powell. I've watched so many of her hearings, and yeah, I think she got a thing for him.
In those lessons, you also said, quote, that you agree with and support, end quote, Vice Chair for Supervision Barr's recommendations for strengthening the Fed's rules and supervisory practices for the big banks, and that you're, quote, confident they will lead to a stronger and more resilient banking system, end quote. So I just want to be clear. You haven't backed down from any of your comments from a year ago, have you, Chair Powell? Right lessons, don't let this happen again, supporting Vice Chair Barr's recommendations, which include stronger capital standards.
No.
You still stand by all that?
Yes.
Good. I'm glad.
Yo,
to
leave
hear
him
that.
alone, man.
Now, I understand that those 37 big banks don't like higher capital rules because they are.
Giovanni says, looks like we're getting another NAS retracement to start. Yeah, I mean, give it a sec. Give it a sec. I mean, I gave out the price. It's 258.9. We're at that level. If we see a retracement, great. If we don't, we know exactly where we're going to get the pullback. So don't rush it.
Rules.
Patience pays as a trader. You don't get paid to just take trades. You get paid to wait. You get paid to let the market come to you. And if it does not come to you, let it go. All right.
Exactly are they trying to impress? A man on the inside? You know, despite all you said last year when the banks failed about.
She's giving this like sincere thing, but she's reading word for word what her staffers wrote. It's like, look, you're either going to be sincere or you're going to read off the script. Don't do both.
Efforts inside the Fed to weaken the capital rule. You even told the House Financial Services Committee representatives yesterday that you think it's, quote, very plausible, close quote, that you withdraw the rule. As one analyst put it, quote, I don't think they will pass a final rule without Powell's support, suggesting that the rules will have to be weakened, quote, to appease Powell. So, Chair Powell, I'm having trouble reconciling the statements you made last year, which you say you hold on to, statements you made when the headlines were all about 3 giant bank failures, and now your report.
The thing is, she's not any worse than everybody else. Like 90% of the early speakers, like the first 3. Kennedy was the worst, dude. You can't do worse than that. Like the whole I'm your grandmother giving you a hard time spiel, even though she's getting paid millions behind the scenes from the same politician. Like that's all okay. I'll take that over Kennedy talking about the FDIC. The FDIC is not a function of the Fed. He just threw that out there just as a shock factor. That was you guys remember that? Talking about all the sex parties at the FDIC. Bro, the FDIC was like, you know, the most boring institution of all time. Now you're telling me that they're wilding out. This is the new Wolf of Wall Street.
They're related. They're not the thing that is directly related to Silicon Valley Bank. As you point out, they're a longer run thing. And I would just say that we put them out for comment. We got the comments. Anybody's free to go read the comments. My view is that it will be appropriate to make material and broad changes to that before we finalize it. And in terms of, I didn't say that
Material and broad changes to strengthen the rules?
material and broad changes, and we're talking about what that'll mean in the end. I did not say that we would withdraw the rule. I said, there's a concept of reproposal, and I said we hadn't made a decision on that, but that if that turns out to be appropriate in the view of the Board of Governors, then that's something we would look at doing.
So everything you said a year ago about supporting the vice chair who is responsible for writing these rules?
You and I had a long colloquy.
Yes, we did.
Yo, she's trying to start insider beef inside the Fed. She was like, oh, so you and your friend don't agree, right? So you saying he's a liar? Why is she trying to create divisiveness in the Fed?
Chair Barr to get us strong rules. And now he is putting out rules.
That
and
was
you're
about
talking
Silicon Valley Bank.
proposing.
The vice chair for supervision has every right to bring proposals to the board. That has happened. But as I made clear in our colloquy, you're not the comptroller of the currency. This is.
He said, just like I already told you, Warren.
Vote. There are 11 other voters, and that's the way it works. It's not different for the vice chair for supervision.
You are the leader of the Fed. And when the heat was on last year, you talked a lot about getting tougher on the banks, but now the giant banks are unhappy about that. And you've gone weak-kneed on this. The American.
She called him weak knees. Yo, son. Nah, bro. Yo, that's crazy. She got that energy today, though. This is why, I mean, I don't hate her. Like, she got the fire. So, but Jay Powell got to step up.
And are continuing to see the impacts across.
She called him weak-kneed and flaky because he shifted his opinions, and she called him she said you're backing out on what you said about supporting your friend. Yo, those are three things you just don't say to somebody, bro.
To continue the fight despite political pressures you may face.
She had some
Last time
Cubano
I
this
checked,
morning.
it's going to get a little more political around here between now and November. I'm also encouraged, contrary perhaps to my colleague from Massachusetts.
Yeah, Kennedy, he's not related to like the Kennedy family, but that's probably how he got elected. People saw the name, they were like, oh, I mean, I guess.
Proposed would have significant detrimental impacts to credit cost and availability.
Yeah, the comment section's hilarious today, bro. You
And
guys got a sense
lastly, I
of humor.
commend your answer yesterday that the Fed is not a climate agency, and considering the impact of climate change is not a factor in achieving your given mandate, congressional mandate of maximum employment and stable prices. Mr. Chairman, I recently joined many of my colleagues in writing to you about my concerns about the long-term debt proposal that would mandate regional banks issue new long-term debt. I'm concerned that this will have a disproportionate impact on smaller regional banks.
Man,
because they're required to hold.
Didn't Haggerty and Vance both just bring this up and then go through it in a much more articulate way? But like, these guys even pay attention. His staffer is just like, this is when you copy your friend's somebody's test on a like in class, and you go up for the presentation. It's like a worse version of what they just did, and everyone's like, bro, really?
155.
So have a longer term debt proposal aligns with that? Mm-hmm. So first of all, they got to stick to the script. Yeah, exactly. He was like, shit, I didn't have any questions. I'm not an independent thinker. I can't think for myself, but somebody already asked this. I'm just going to ask the same thing. But in the first place was that those banks are not subject to the living will process to the extent that the GSIBs are. And this was sort of meant to be a middle step to make them more resolvable without imposing all of the burdens that we impose on the 8 GSIBs to have very elaborate resolution plans. So that was the GSIBs are the globally systemically important banks. Those are the too big to fail banks. The ones they bailed out in 2008 because they were, so intertwined in the economy that their failure would cause a crash like we've never seen. So now they call them GSIBs, globally systemically important banks.
Understandably, you've had to raise interest rates to fight the fires of inflation brought on by reckless Democrat spending. However, a major side effect of that is the impact the rising rates are having on the cost of servicing the out-of-control national debt. Senator Haggerty alluded to this a bit in his questioning minutes ago. Looking at CBO reports, interest payments on our debt will increase 32% this year and will now exceed spending for the entire Defense Department. I have significant concerns. Many do here in Washington. Many Americans do that we.
Oh my God, bro. This dude sucks, bro. The Congress controls the federal budget, which pays for the defense sector, not the Fed. The Fed just cleans up the mess of Congress.
On government debt, or even potentially the risk of a default. Chairman Powell, I know fiscal policy is not in your purview, but could you ever foresee a situation where fiscal irresponsibility snowballs to a point that the Fed would have to factor this into its decision-making? I think we're a long way from that. And that's that's a terrible place to be. That's a place where some poor emerging market countries have found themselves over the years. For the United States to get that point, I think it's unlikely. But I do think that, and it's not our business, we should stay out of this fiscal business, but I'll say what other Fed chairs have said, which is we really need to get back to that discussion about fiscal sustainability. And both sides need to get together. The kinds of things that have to happen can only be done on a bipartisan basis. And
the only reason I'm in favor of a new Fed chairman is we need someone who's tough, who hasn't been there so long and buddy and is on the way out, because he needs to be the parent in the room to tell Congress, yeah, we need to sit back at the table for fiscal sustainability. Bro, someone needs to step in here and tell them, if you do not cut this out today, this country will fall off of a cliff. We're about a decade away from this becoming a major problem, raising taxes by 10% on the lowest end and maybe 20% on the higher end. $3.5 trillion of deficits a year is insane. And we're just getting warmed up. So Fed Powell really needs to kind of get more aggressive with holding Congress accountable for their actions.
Going with, particularly with all the other things that are going on, we're looking at some, and this is in response to Silicon Valley Bank, we're looking at some liquidity innovations, and we're asking ourselves, which form should that take and how long should it be out for comment and that sort of thing. We're not ready to do that yet, but that's
liquidity innovation is a fancy word for saying new ways to print money. Okay? Liquidity innovation is the funniest thing I've heard from Powell this whole time.
Requirements.
Liquidity innovation. I love that
All
shit.
necessary data collection that would allow for meaningful analysis of all potential policy options.
And please keep your answer short, Mr. Chairman.
maybe. No,
That's very short. Thank you.
I can't, we can talk about this more, but I don't want to make a really specific commitment like that without talking to the people who are, carefully in touch with this, but that is the right thought.
Thanks, Chairman.
Thank you, Senator Fetterman from Pennsylvania is recognized. Well, he got here last.
No.
So although if Senator Warnock sits down in the next 5 seconds, he's next. So Senator Warnock, are you ready or you want to go to?
This man rocking a hoodie in the Senate.
The junior colleague.
Senator Fetterman's recognized.
Much better. All right. Okay.
Warnock is recognized from Georgia.
Thank you, Chairman. Thanks. Thank you very much, Mr. Chairman. Bank spending on buybacks is rising again. And their consumer small.
Yeah, they're fucking with his mic.
Interest rates are high, yet the interest being paid to depositors, ordinary working families, working people with bank accounts. Not a lot of money in Wall Street accounts remains low. Chairman Powell, I'm concerned that when banks don't increase the interest rates on bank accounts, families are losing out on dollars that could be in their pockets. Again, they don't have the kinds of portfolios that some of the folks in this room would have. Is that good
Nancy
for the
Pelosi.
economy? And are you concerned that banks under your supervision are doing this?
Quick Pelosi jab.
That's correct.
That's a question I haven't heard. Of course, they have the option of putting their money in money market funds, and banks compete with each other. But I'll be happy to look into that. I hadn't heard that concern.
And I think it is worth taking a look at. Many lower income individuals and families, again, they don't have some of the sophisticated products yet. Money markets are available, but we saw high interest rates and that not being reflected in what depositors are able to benefit from. Could those individuals and families benefit from a high interest rate on their deposits?
Sure. And it's for a long time, we had a lot of mail from people at the Fed.
All right, I'm going to stick around for another 15 minutes and then call it a day. What I'm going to do is probably just do another live stream or just drop a recorded video with a full breakdown of what happened, some of the key parts and how that impacts markets. I'm going to try to stay away from the higher level macroeconomic stuff like the Basil Accords and some of those specific technical details, but I'll go through some of his key comments about interest rates, the potential for rate cuts this year, sentiment in the markets based on what he said, and then of course that crucial comment about CBDCs. So I'll be another 15 minutes. Any questions, pop them up in the chats, and yeah, let's see how much we can get done in 15.
Are you concerned about?
Yeah, I don't know. Is Fetterman effective as a senator, bro? If anybody knows anything about Fetterman, because look, if you're dressed like this and you're just getting shit done, I'll give it to you. I'd rather take somebody in a hoodie getting it done versus somebody in a suit fucking everybody's life up. However, if he's also not getting it done, because every person I see that doesn't respect the dress code in the Congress typically is not useful to their state. So if anybody has any background on Fetterman, let me know real quick.
Homes with a very low rate mortgage that they can't afford to refinance, so they're not moving, which means the supply of regular existing homes that are for sale is historically low and very low transaction rate. that actually pushes up prices of other existing homes and also of new homes because there's just not enough supply. The builders are busy, but they're running into, all kinds of supply issues still around zoning and workers and things like that. So it's quite challenging. And of course, rates are high. So people who are buying, a lot of the buyers are cash buyers or are able to actually pay without a mortgage because mortgages are expensive. I will say the first problem, the longer run problem of supply, is a longer run problem. The other problems associated with low rate mortgages and high rates and all that, those will abate as the economy normalizes and as rates normalize. But we'll still be left with a housing market nationally where there's a housing shortage.
There's no question we have a supply issue. And this issue of high prices, lack of supply, of course, disproportionately impacts some communities more than others. According to the Monetary Policy Report, the employment rate for the Black prime age labor force, that is persons between 25 and 54 years of age, reached a historical peak in 2023. The gap between Black and white prime age employment dropped to a nearly 50-year low at around 3%. We can appreciate progress, but a 3% gap is still significant. Would you agree that it is important to continue?
Roy, he literally had a stroke and is not functional. Oh, damn. Checked himself into a mental hospital and also has never held a real job in his life before being elected. Lived off his parents' money till he got elected, and he chased down a black jogger with a shotgun in his neighborhood. Bro, what? And he's got the balls to just walk in here with a hoodie on? And Pennsylvanians elected him? Yo, this is just goofy, man. Respect the office that you're in. You want to wear a hoodie and you don't want to follow these kinds of rules. Great, you're in a capitalist society. Go start a business. Look at Mark Zuckerberg. Wear your flip-flops and a hoodie. Do it. No one's going to tell you anything. Elected officials got to conduct themselves, in a respectable way in accordance with, the environment that they're in. Judges wear their suits. Elected officials rock their suits, right? It's a professional environment.
There's been some chatter lately on the social media that people are concerned about the Fed creating a CDBC without legislative authorization. You and I have discussed that before.
She just said CDBC. Now, this is Senator Loomis. She was a huge supporter of Bitcoin and crypto regulation, so I got a soft spot for her. There's better people on the committee to talk about these things, but she's at least on the right side, and she's for the people. So, I like Senator Loomis.
Agree that the Federal Reserve cannot introduce a U.S. central bank digital currency without congressional authorization.
Yes, I do.
Thank you. That's really calms people's fears, the people who are concerned that we could end up with something like the digital yuan that is used as a means of surveillance. So I think that will calm some of those discussions down. Thank you so much. My next question is about your core CPE. Now, as you know, there's a disconnect between how...
Did she just say CPE? Bro, no, this is ridiculous, man. She just said CDBCs, and then she just said CPE. It's PCE, price or... Oh my God, I'm about to fuck this up. I think it's price consumption expenditures. Hold up. Personal consumption. My bad. But yeah, it's personal consumption expenditures is the key metric that the Fed uses for inflation. More accurate and effective than CPI, because CPI is more of like a survey, leaves out a ton of important things that we all pay for. But PCE.
Factor in the thing.
CPE. Ain't that what Antonio Brown got?
Actually, we do. Our statutory target is inflation. It's not core inflation. So, and if you look at headline inflation over the last 12 months, that's it. That's our goal. It's 2.4%. Core inflation is actually higher than that. It's 2.8%.
That AB joke was out of pocket. All right, it was a CTE joke. No one laughed at that. Yeah.
Target is headline inflation, which is, it's our best effort to capture the cost of living that people face. It's not perfect. It's very, you have to make all kinds of judgments that aren't easy. I mentioned that housing earlier. How do you measure housing inflation? Lots of issues, but that's what we target. The reason we look at core, though, is that headline inflation tends to be more volatile, and it tends to be pushed around by commodity prices, which really don't relate to the overall state of the economy. Is it tight? Is it loose? So core tends to be a better predictor of overall inflation than overall inflation is. I know that's complicated, but ultimately, though, our target is headline inflation, which does include food and energy.
Mr. Chairman, I'd like to include a letter in the record that Senator Tillis and I and 2 Democrats on this committee have submitted with regard to Basel III. My question—
Without objection.
Thank you very much. My question is this: what do you think is more likely?
So he's not going to answer any Basel questions, as he hasn't done in the past 2.5 hours, if she's been paying attention. But in case you guys don't know, the Basel Accords were a response to the 2008 crisis. They were a set of banking regulations that required things like capital requirements and other insurance features to be implemented that would create more security in the banking system. So right now they're talking about revising it because they are very outdated and very restrictive. Hopefully they don't go too far and get too loose on those regulations, because the banks were very sketchy. And hopefully they reduce regulation on the rest of the financial system so that, you know, prop firms can come back and crypto companies can come back without the fear of government scrutiny. So Basel, very important. And then there's also, what else? That's basically it.
In addition, there would be non-bank lenders that are more than happy to make that loan.
I have a chicken and the egg question here. Starting with TARP in 2008, there has been a very aggressive printing of US dollars up until today, and it particularly went on hyperdrive during that 22-month period of COVID. So my question is, which comes first? Congress spending more, and so you respond by printing more money, or are they separate considerations?
Chicken and the egg.
I
That's a tough one. Yo, that edible kicking her ass, bro. She got a point.
We don't print money to fund the deficit. That's not what happens.
That's a bold-faced lie.
When the government borrows, it issues.
Hold up. That was a bold-faced lie.
Fund deficits is what happens.
Right. And so that's, so that would indicate to me that you do respond, because we, in spending, in deficit spending, are creating a demand to borrow. And you're responding by—
Well, we're not making loans, though. You know, we're not lending money to the government. We're not financing these deficits.
And so there's no chicken and the egg relationship?
There's not really, no.
There is. Yo, why is he
about
lying like this, bro? This is the biggest lie he's told in a long time. That's just objectively not true. They do finance the deficit.
About fiscal sustainability and how we can work with you and bipartisan, maybe next year, to address these issues. You know, when you say things, you have to be careful, because what you say has ripple effects outside of this building.
Yeah, she said, don't lie, bro. Like, this is, everyone's going to know.
Bipartisan basis, and have those discussions in a frank way.
Thank you, Senator Lummis. Senator Fetterman of Pennsylvania is recognized. All right, Senator Van Hollen.
Yo, guys, look at his face. She said, I can't say this in front of the cameras, but we can talk behind the scenes, because we all know what's happening here. But if you don't want to say it in public, I got you. We'll talk behind the scenes. That's insane. You can see how mad he just got.
Right? That's good news.
Yes, over the last couple of years, you know, wages have been going up more than inflation. Real wages broadly are up.
That means more families have more spending power in their budgets, right?
Yes.
Worker productivity is up, right?
Yes, it is.
Corporate profits are up, right?
I believe so.
And worker productivity is rising faster than corporate profits, right?
I don't know the answer to that. That may well be right.
The charts I show suggest that. So that would indicate that unless, corporations decide to pocket as profits more of the gains they get from their workers' labor, that we should be able to continue to have increases in real wages. Is that right?
Yeah.
And so it's important, I think, that, people recognize that these corporations are doing better than ever. And they are deciding now to essentially return the gains made through their workers' productivity, which is going up, more to shareholders. Obviously, shareholders are going to get a profit, but
Oh yeah, great point. So yeah, the State of the Union address is tonight at 6 p.m. Biden will be giving a speech addressing the entire country. God help us. Okay. Man, oh God. Right. This is like running right into a brick wall, and everyone sees the brick wall. Everyone's in the back yelling at the bus driver saying, please don't, please no. And it's gonna happen. And it's gonna be a laughingstock. Now, I don't know what they're gonna pump him up with to get him up there and wind him up. He might deliver a speech that's coherent enough to shock the world. But oh God, not good.
Who increases in productivity.
I appreciate that. And I also there's the trade-off on workers' wages, and there's also an issue with price gouging, right? So we have seen record profits. We've also seen very high prices these corporations are charging for things like groceries. Now, I listened to a little bit of exchange with the chairman earlier, and of course, I think your answer was, people will charge what consumers will pay. But it should be known that these corporations are reaping much larger profits now than they were pre-COVID, for example, right?
I mean, some of them are. I'm not super focused on individual corporate profits, but yeah, corporate profits, I gather, have been high overall.
Right. I mean, they're high for a couple of reasons. One is that they're charging consumers, for example, at the grocery stores, a lot of money. And the other would be if they're not sharing the benefits of labor productivity with their employees. So I think because we've heard a lot of claims by some of our reporters.
You guys know who used to talk like this? Is a guy, he wrote a very famous book. His name was Karl Marx, in case you've ever heard of him.
Recognize that corporations are choosing to charge them more at the grocery store or engaging in things like shrinkflation rather than in order to have more of their profits. Let me turn briefly to a letter that I sent to the Vice Chair of Supervision and some of the other federal regulators in January of this year regarding the Basel III capital requirements. And I support the overall effort on Basel. We did raise concerns with respect to a specific issue, which is the harmful and we think unnecessarily harmful impact it could have on clean energy tax credit investments. And all of the regulators testifying that day, including the vice chairman, said they recognized this was a significant issue and hope to address it. Would you agree with that?
Yes, I would.
Thank you.
Yo, man, these tax credits, bro. That does not concern the average American. Nobody cares about that stuff. There's real concerns here.
Now,
Big Fetterman.
In America, we're talking about
not the tribal tattoo.
$18. And I was alarmed, and I hope we investigate that there is a.
He looks like that cool principal that's always like, oh, what's up, guys? Like just one of the guys.
Do you believe that an anecdote on Twitter about a cookie that cost $18, is that reflective of our economy and where we're at or not?
I certainly hope not.
Talking about an $18 cookie, bro. Jesus, bro.
Yeah. And now, and I believe that that the American economy now is the envy of the world after everything right now, correct?
Yes, we're performing very, very well compared to.
Yo, I wanted to give him the benefit of the doubt. This dude comes out with an $18 cookie question. My God. He did not disappoint.
Highs, right?
Pretty close.
Yeah. And inflation has been pretty effectively addressed, right?
It's been coming down sharply since the middle of last year. Yes,
Yeah,
we got a ways to go on that, but we've made a lot of progress.
And corporate profits are pretty robust. Is that fair?
I believe it is.
Okay. Well, we can agree that, and I don't understand why more people seem to be talking about a cookie that cost $18, but that seems to be against the evidence as well. But given that, now, since things are pretty great and we're in a really great, excuse me one second, place, but now I am concerned, and there's rumors going around that Basil they're going to change and they're going to reducing the capital, and I guess I'm concerned about that because I don't know why we would want to, and also I want the record to reflect on you're much smarter than I am. But I would be concerned that things are in a really great place right now. We can all agree on that. I would be concerned to change something like that because I wouldn't want to have something again like what happened with SVB. And I just wanted to get your take on that. Is
Sure. So U.S. banks are well capitalized, and generally speaking, they're quite well capitalized. And we're not talking about reducing current capital levels at all. Really, in the Basel III endgame, capital may well go up. And what we're talking about is whether the proposal that was put out by the bank regulatory agencies, including the Fed, and which has now been the subject of quite a lot of comment, whether, what changes will be appropriate to that. That's what we're talking about. We're not talking about reducing existing capital requirements.
Okay, well, and then I also want to play off of a comment made by my colleague from Tennessee, and I actually agreed with him. And he's concerned about the deficit, about it's $1 trillion for every $100 days. So now, if the federal government had added $3.5 trillion to the deficit by extending the Trump tax cuts, would that increase or decrease inflation?
So I'm going to fall back on our long-time reluctance to comment on fiscal policy. We take your fiscal policy decisions, whatever they may be, we take them as they are, and we conduct monetary policy to achieve 2% inflation. But we don't score inflation. CBO does that. They'll make a judgment on that, but it's not something we do because we're an independent agency, and that requires us to stay the heck out of politics.
So I don't want to put you on the spot, but would those kind of tax cuts would that help addressing inflation or inflame inflation?
I don't know what the effects would be on inflation. I do know, broadly speaking, we need to get to a place where revenues and spending are better aligned. And I think everybody knows that. And, I think we used to talk about this a lot 10 years ago. We're not talking about it so much anymore. That's understandable. The pandemic was a special thing. But I do think it would be great to get back to that on a bipartisan basis.
Okay. Well, I have about 30 seconds left. I just want to go on the record. I think you've done a really great job. And I think our economy, and I do agree that it is the envy of the world as well. And I'm confused that more people are talking about cookies or McDonald's meals and those kinds of.
Well, you're the one that brought it up.
On the strength of this as well, too. And I just want to thank you for your service.
Thank you, sir.
Mr. Chairman.
Thank you, Senator Fetterman. That's the last questioner. And thanks for your generosity and yielding to colleagues who got here before, whom you got here before, if I said that right. Thank you, Chair Powell, for joining us today. And every 6 months and sometimes more often, I look forward to working with you.
Okay, well, that was actually that was earlier than yesterday. Yesterday, I think maybe this is going to keep going, but I'm getting ready to hop off here. Great stream, everybody. If you enjoyed this or you learned something, make sure to drop a like on your way out. Also, don't forget to check out the FX Summit 2024 conference. Grab your tickets before prices go to full price. Early bird tickets are on sale. You have another couple of weeks, I believe, until tickets go to full price. Make sure to get your tickets. Also, Trading Psychology Bootcamp is tonight. You have about 6 hours to grab your tickets if you haven't already. If you guys want to kickstart your year, supercharge your trading, get a rock solid mindset to not only hit your goals, but exceed your expectations for this year, to set higher goals for yourself, make sure to check it out in the description below, chartaddictsfx.com. Looking forward to seeing everybody tonight. Let's get ready to kick off 2024. All right. See you guys later. Happy and safe trading, everybody. Take it easy. Peace.